Let's talk software on Hot Picks today. Our guest covers the tech sector, and Microsoft is among his biggest ideas, his best ideas. We are joined by Tyler Radke, a director and lead equity research analyst at Citi. Tyler, great to see you. Microsoft trading at record levels. Why do you like the stock? You do still see upside.
Yeah, we do. We see over 20% upside still to go. We have one of, if not the highest price targets on the street. And basically our view is that Microsoft is certainly the largest software company out there, but also the largest play on AI. And I'd also say the highest quality play on AI. So not only are they providing the infrastructure for training and inferencing for a lot of these large language models, they're able to monetize it across their portfolio. And I think where this gets really interesting is heading into next quarter. A couple of weeks ago, we took up our Azure numbers above the street. We think estimates are too low. And so as they report their fiscal Q4, which is the June quarter, you should see numbers revised higher and see Azure growth potentially grow as high as the high 30s next year. Consensus expectations are in the low 30s. So still think there's a lot of upside to numbers. And the stock is still trading at a reasonable valuation, a low 30s GAAP earnings multiple. Names like Oracle, for instance, are trading above 40. So we do think there is more upside on the stock from here.
And sorry, you may have mentioned this, but is Azure, the cloud computing business, a big source of earnings for Microsoft now?
Yeah, so it is probably the most important KPI on the stock. In terms of its earnings power, again, this Azure is very, very high growth, right? Over 30% growth. It is quite profitable, not quite as profitable as some of the more mature franchises like Windows and Office and everything. But we estimate the margins are well north of 30%. So it is a big driver of earnings. I think it's frankly though a bigger driver of the multiple, right? The faster that grows, the more duration and the more earnings power it drives longer term. So really that's the metric that I think will move the stock here in the coming months.
Another idea you have is MongoDB, MDB on NASDAQ. Just remind us what the company actually does, if you would, Tyler, and tell us why you like it.
Yeah, so MongoDB is a player in the database market. And so the database market is one of the larger markets in software, over $100 billion a year. Databases are kind of the foundational elements of building an application. So, if you think about any type of application, whether it's a mobile application, web application, something you might use in an enterprise, databases power that. And, Mongo, it's been a sort of a rough year or two for them. The stock is definitely not at all-time highs, but we think that some of that negativity is starting to reverse here. So particularly around this AI theme, we do think that the company is well-positioned long-term. Last quarter, they called out some pretty high-profile AI wins, companies like Cursor, and we think that their cloud business is starting to re-accelerate growth. We see upside to numbers, and so ultimately, as this company begins to execute better, you start to see some of these larger AI applications move into production. We think that will sort of tilt the sentiment back to this being an AI winner. So you have upside to numbers and multiples still to come.
And then your final idea is Snowflake, the software vendor. This one near record highs.
Yeah, Snowflake has definitely had a good year. I think it's up close to 30% on the year. But ultimately, this is a company that also sort of went through some challenges over the last 2 years. There was rising concerns around competition, vendors like Databricks, as well as some of the hyperscalers getting more competitive. But under the new CEO, Sridhar Ramaswamy, who was a ex-Google executive, really smart engineering background and product development, he's sort of reinvigorated the R&D motion of this company. So you've seen them come out with a lot of interesting new products, AI products that help business analysts and folks at enterprises around the world be able to do different types of queries and effectively drive consumption higher. And so you've seen a lot more consistency from their results. We were out at their Snowflake Summit a few weeks ago out in San Francisco, really liked what customers were saying on some of these new products. And so ultimately, I think this is a company that will continue to grow, at least in the high 20s, a lot of upside to numbers. And I think they're well positioned on this AI theme.
Tyler, how does it feel these days being an expert on tech or an analyst on tech with stocks near record highs? Do you get a feeling of any kind of bubble at all? I mean, I know these companies are making serious profits.
Yeah. Well, it's interesting, and we just hosted our generative AI summit at our headquarters earlier this week. And while there are some very exciting public companies, we talked about Microsoft, obviously you have NVIDIA and names like Palantir that have done extremely well. Frankly, I would say that the more elevated valuations and arguably risk of a bubble is in the private markets, right? If you look at some of these private companies, getting $10 billion valuations with little to no revenue, or even a business plan. But I do think that speaks to just the power of this transformational technology. And what makes it tricky is there's a lot of public software companies out there. I mean, there's probably close to 200 publicly traded software companies, but very few of them are actually benefiting from AI thus far. But in the private space, you probably have several dozen companies that have gone from zero to over 200 million in revenue over the last 3 years. So very interesting kind of dichotomy between the public and private space, but not very concerned around bubble valuations in the public space, with maybe the exception of, say, like a Palantir that trades at like 70 times forward sales. But obviously they're a great company and executing well. So there's definitely some justification behind it.